Now, Partners Group Chief Investment Strategist Anastasia Amoroso. Anastasia, what does it say when even fireworks from a company like NVIDIA start to look like warning flares to investors?
Sure, Liz. Good to see you. I think it says a lot about positioning. Going into NVIDIA earnings, I think positioning was certainly stretched in terms of longs on NVIDIA. It seems like it was really short software. And it's interesting. If you looked at the same stocks last night, you would have seen NVIDIA trade up. You would have seen CRM, Salesforce trade down. And I think a lot of the reversals has to do today with some technical forces. But I do want to just defend more broadly the AI trade. And, what NVIDIA really said is that the demand for compute is essentially expanding exponentially. It is insatiable. And I really also liked kind of the new growth engine that Jensen Huang has referenced, which is this adoption of agentic AI. That's new. We've been in the era of sort of conversational AI, consumer AI. We're now moving into the era of enterprise AI being embedded in more and more software applications. So I see a lot of positives actually coming out of that NVIDIA report, and even Salesforce as well, talking about the adoption of agentic AI in their business.
I mean, look at software stocks. They've been absolutely crushed over, I want to say, the last couple of months on all of this AI disruption fear. After the bell, we are getting a bunch of names, and they're tech names, and some of them are really crucial software names. I'm thinking about Autodesk, Zscaler. And if you look at, say, for example, Zscaler, down 27% year to date, Autodesk down 22% year to date. You're saying, please do not over panic on these stocks, and wait till you hear what Jensen also says about it.
Yeah, absolutely. I think investors need to take a near-term kind of stance on software versus a longer-term stance on software and pockets within software. The near-term stance is that I looked at the numbers of companies that have reported, and we're getting 80% of those reported, and they're delivering earnings growth of about 20 or 30%, and pretty decent earnings beats as well. So, so far, there's certainly no death of software, and certainly not in earnings. Longer term, Liz, I would say there are definitely going to be pockets of legacy application software, which we do have quite a bit of in public markets, that likely will have a slower growth trajectory. And that's what investors are pre-positioning for.
A little bit of a shakeout there. But if you look at the AI trade, we've had so many people sitting in that chair and saying, oh, go with the nuclear names, go with the energy names because they are there. Go with the picks and shovels and the blue jeans of what could be the AI trade. You talk a lot about the industrial picture and how important it is.
Right. I mean, it's been hugely important, I would say, and played out in the market so far this year. If you look at energy, if you look at, the industrial names, the defense companies, they've actually outperformed just about everything else this year. And that's right, Liz. If you look at CapEx numbers year to date, they've really inflected higher. And what's driving this CapEx is starting to look a little different. In the last 10 years, it's all been about software CapEx and spending on software that was going to eat the world. And here we are today, and the ratio of hardware spending to software spending is getting close to 50%. So there's this heavy asset reallocation that's happening.
I want to give a little preview of what Jensen Huang specifically said about in essence, the fact that AI may be the first sort of technical revolution that isn't a blue-collar job killer. So let's take a look and listen to that.
Don't forget, AI is creating jobs all over the United States. All these AI factories and all the data centers, the chip plants, the computer plants, and the AI factories that need to be built, the number of trade skill labor jobs that we're creating around the United States is really quite extraordinary. I'm delighted to see it. And that's a whole segment of our economy and a whole segment of our society that we really would love to have built back in the United States so that we could become a re-industrialized country again.
As a whole, and I would tell you, you look at the leverage ratios for private credit, for example, they've consistently declined for some of those private equity sponsored transactions. And in fact, leverage levels are the lowest levels since 2009. So some of those positions have been de-risked a lot. If you look at the equity cushions that you have in some of these private credit deals, they are now at 50 or 55%, which means the stock would have to go down a lot, or rather the private equity or private portfolio company would have to go down a lot in value before you sort of breach the credit cushion that you have. So, perhaps some of the concerns are stemming from AI disruption, but I would say they're certainly premature, and signs of stress are not visible in private credit.
Well, the Dow is looking a little bit less stressed. It's up 69 points.
That's welcome, for sure.
We're seeing a bit of inflation, or at least inflating there. Good to see you, Anastasia.
Good to see you, Liz.
Please come back. Thanks so much.
Thank you.